Hello everyone, I'm Satish and I'll be giving you a basic overview of the Procure-to-Pay process. This tutorial is aimed at beginners from the field of process consulting and internal audit. I'll take you through the end-to-end P2P process and also help you identify who your key stakeholders would be. Before we begin, a small reminder that you always need to ask these 6 questions whenever you are interacting with any of your stakeholders and whenever you're conducting a walkthrough. Please ask these 6 questions: who, what, when, where, why, and how. So let's move on. So P2P, procure to pay, as the name suggests, all the activities that a company would do right from the time it purchases something from its vendor till the time it pays its vendor is classified as the P2P process. All companies would have their own set of vendors from where they would purchase either goods or services. Everything typically starts with requirement planning, which is the first phase. This would typically be done by the planning team or by the user department. So if it is a manufacturing company, they would know in terms of what stock they need to hold so that they can manufacture the quantities that they intend to manufacture. So it is sort of a backward working where I would calculate how much stock I need to hold for manufacturing my next week's or next month's plan. So my purchase requisition essentially would be a list of items that I need to have in stock to manufacture my finished goods. So my PR or a purchase requisition would be initiated by the user department or by the planning team, and this PR would give a detailed list of items along with quantities that need to be purchased. Most companies have a process wherein the purchase requisition is approved by the stores department. Now, why that would happen is because the stores department would actually go back and check their warehouse to see if any of the items that the user department has asked for are in stock, which means that if those items are already available, I should not be incurring any fresh purchase towards them. So once the purchase requisition gets approved, it would move on to the RFQ or the request for quotation stage. Now, this is the domain of the sourcing team or the purchase team. The purchase team would have identified a set of vendors that would be providing that particular material. So I would have identified say 3 to 5 vendors who are providing XYZ material. I am required to reach out to them, send a request for quotation along with my requirement for the goods or services as given in the PR. The vendor then goes through the requirement list and is expected to come back to purchase team with a quotation. The quotation essentially would give the rate at which the vendor is willing to sell the goods to our company. The purchasing team then would prepare a quotation comparison sheet. This would essentially be a sheet where they are putting in all the materials for which the RFQ has been raised and the quoted rate at which their vendors have sent them their quotations. Now, the quotation comparison sheet also goes through an approval process typically within organizations, and that is in order to ensure that all my comparisons with vendors are happening on an apple to apple basis, which means that all the terms and conditions, including the credit terms extended by my vendors, should be uniform. The material make, quality of the material, specifications should also be uniform. Only then I would do an apple to apple comparison in my QCS. So the outcome of the QCS would be where the purchase team identifies that one vendor is quoting lower than the other, and that is why a purchase order needs to be awarded to the vendor who's quoting the lowest, because the aim of the sourcing team always is to derive efficiencies in terms of how lower they could purchase a particular material. Now, once they've identified the supplier who's going to be supplying at the lowest rate, they would then go in for creation of purchase order. Purchase order creation process typically, say in an SAP environment, would be workflow driven, which means that the PO would have to be approved by the delegated authority. line with the value for which it has been created. So once it is approved, the PO is sent to the suppliers. The suppliers are required to acknowledge the purchase order. Now, typically, the purchase order would also come in with its own set of terms and conditions. It can also include dispatch terms, which means that you would also define what are the dates on which you are expecting the deliveries. The delivery schedule would be given, and the vendor is requested to supply as per the delivery schedule. On the dates on which I am expecting the goods, the vendor would then supply. These goods would reach my factory location or my warehouse location, where these would then be handled by the warehouse team. The warehouse team is expected to ensure that the materials that have reached the warehouse are in line with the purchase order which was raised. So number one, check is for quantity, to check if the quantity is as per my purchase order. Number two, they need to check if the material that is received is of the correct specification or make or description as per the purchase order. And they also need to check that the vendor invoice and delivery documents are in line with the goods that they have physically received. So once they satisfy themselves, they would then post a GRN, a goods receipt note, in the system. Now, a GRN basically confirms that the goods have been received on site. They are not necessarily a measure of whether the goods received are of good quality. So most companies post the GRN stage also have a quality check, which would be performed by the quality management team in-house. And these are the guys who would ensure that the material that has been received conforms with the quality norms that have been documented as part of my purchase order. Once that is done, the invoice would be sent to the accounts team along with the delivery documents. Now, the accounts team basically would be required to post this invoice, which means that they would recognize that a payment needs to be made to the vendor against the supply that they have made. Now, at this stage, what becomes very essential for the accounts executive to post this invoice are three things. Number one, of course, the vendor invoice, which would document what is the quantity and rate of supply. The second document is the GRN. So this basically acts as a proof that the stores has acknowledged the receipt at the warehouse. And the third document is my purchase order. So whenever an invoice is being posted, what is very essential is for the accounts team to check if there is a goods receipt happening against a purchase order against which this invoice has been raised. So that is the reason why this is known as a three-way match, and that is a concept that we'll probably discuss in our next tutorial as well. So once the invoice gets posted, it would then come up for payment. It would be paid as per whatever is credit period agreed with vendor. Typically, companies have anywhere between 15 days to 45 days of credit period, or even more than that in certain cases. And that would flow from whatever was agreed at the time of negotiation with the vendors. Once the payment is made, the payment entry is recorded in the system, and that is how the reporting would happen. So if you look at it, end-to-end process, it started with identifying the requirement. So you had the purchase requisition created here by the user department, on the basis of which RFQ or request for quotation was circulated by the sourcing team. On the basis of response to the RFQs, vendor was finalized and a purchase order was created. On the basis of this purchase order, goods were supplied by the vendor. On the basis of goods supplied by the vendor, a GRN or a goods receipt note was prepared in the system by the warehouse person. On the basis of this GRN and the vendor invoice, it got posted in the system by my accounts payable executive. And on the basis of the invoice posted in the system, a payment was made by the bank executive or the treasury executive. And on the basis of this, my reporting or accounting was done. So that is the end-to-end P2P process. And whenever you are trying to study this process or trying to review this process or trying to audit this process, it is important for you to touch upon all these activities. You cannot miss out on any of these activities if you are doing a review of the purchase to pay process. Also, I think what you need to understand is that these POs could be for goods. So when it is a purchase order, these POs could also be for services. And in case of services, it is known as a work order. Only the nomenclature changes, but in essence, the purchase order or work order remains to be the document which commits a particular purchase to the vendors. In case of services, there would not be any goods receipt, but you would have a service receipt. So in SAP terminology, there is a corresponding document by the name of service entry sheet. So instead of a goods receipt note, you will have a service entry sheet which is created against work orders. So that is the only difference that you need to keep in mind as far as goods supply and services supply is concerned. In some cases, you would not have a purchase order or a work order, but still you would end up receiving materials or services. And of course, you need to pay the vendors for whatever goods or services you've received. So in that cases, this particular process would not get followed, but invoice would get posted directly. So this is a non-PO invoice process for which is a little different, and you'll have to keep that in mind as well. So this is the overall review of the P2P process. So let us look at who the key stakeholders are. Whenever you want to study the end-to-end process, please make it a point that you are interacting with all these stakeholders. So I have identified here at least 6 buckets. There could be more or less depending on the maturity and the size and scale of the organization. So please keep this in mind while you are planning for a particular review. But definitely these are the 6 buckets that you need to look at. So first bucket, this is master data team. So how does my vendor code get created in my ERP? So the entire vendor onboarding and code creation process is something that the master data management team controls. And this process you'll have to understand from the master data team. The second stakeholder is the user department or the planning team. These are the ones who would be identifying the total requirement in terms of quantity, specifications, delivery dates, and these are the ones who would be raising purchase requisition. Hence, you need to interact with them. The third group is the sourcing team. These are the guys who actually finalize vendors, negotiate the rates, issue the purchase orders. So these are the ones who would be interacting with vendors day in and day out, and hence sourcing team becomes a key stakeholder. The fourth team would be the stores or the warehouse team. These are the ones who would be receiving the goods and posting the GRN. Sometimes quality management would also form a subset because you would be confirming the quality of the goods received at your warehouse. The fifth team is the accounts team. These are the ones who are going to be processing your invoices, or in case of any shortages or excess material received, credit notes, debit notes would be posted, and these are the ones who would also be posting any year-end or period-end entries like provisions. The last team would be the treasury or the banking team. These are the ones who are going to be processing the payments to your vendors and checking for any advances or any other banking activities that need to be performed. So typically these are the 6 stakeholders that you would have as part of the P2P process. In case you are performing any walkthrough, make it a point to interact with all of these stakeholders. This was my overview of the P2P process. Thank you so much.